Good afternoon, everyone. My name is Paul Smith. We'll be starting our webinar here in just a few minutes. We're waiting for some additional folks to dial in. The ticker is moving along, so once that slows down a bit, we'll get started. So give us another 30 seconds or so, please. Okay, so in the spirit of time, let's get underway here. Once again, good afternoon, everyone. My name is Paul Smith, and welcome to our ongoing Property Casualty Market Outlook webinar. We conduct this on a quarterly basis, and we're happy to have you participate today and hear from our subject matter experts. If you have any questions throughout the webinar, please be sure to ask those in the chat box that's on the right-hand side. You can put your question in there, and we will address those as best we can. If for some reason we don't have sufficient time, we will circle back to you separately. You can contact anyone on today's webinar or your local Burns & Wilcox associate. So again, my name is Paul Smith, Corporate Senior Vice President with the H.W. Kaufman Group, and it's my pleasure today to moderate this discussion surrounding three very important and very, kind of noteworthy areas of our business right now: personal lines, commercial property casualty brokerage, and commercial property casualty binding and delegated authority. So we're going to get into that a little bit today. I'd like to now introduce our panel. Anela Neuenhaus on my left here, Associate Vice President, Regional Practice Group Leader, Personal Lines Insurance. Welcome, Anela. Look forward to today's discussion. Next, if you can raise your hand, George Paul, Associate Managing Director and Casualty Broker with Burns & Wilcox Brokerage. By the way, Anela's in North Carolina, George is in Scottsdale, Arizona. And then finally, Yuri Petraz. Yuri is the Manager for Commercial Insurance at Burns & Wilcox in Chicago. However, he represents the entire, what we'll refer to today as the Upper Midwest region. So welcome, Yuri, welcome, George, welcome, Anela. Let's get underway. So Anela, I am going to start with you. Clearly a lot going on in the personal line space. So how do you see capacity, real big topic these days, changing from last year to this year within the E&S personal line space?
So Paul, I think that's a really great question to ask. I've seen that it's not that there is no capacity, because there is plenty of capacity available. It's just less in certain areas. So areas like Florida, Louisiana, South Carolina, California are big places that come to mind. And it's shrunk a little bit. And, changes have happened to how you can get that capacity. That we've seen a lot of unprofitable business over the past few years across the industry. There's a big push to make that profitable again. So whereas a couple years ago, where we saw plenty of capacity in a soft market, as it's continued to harden, it's shrunk a little. Guidelines have changed and rates have increased. I think we'll continue to see those rates increase with supply and demand, that sort of thing. So yes, there is capacity available, but it looks a little bit different, and it'll continue to look different as we progress through the second quarter into the rest of the year.
Yeah, hey, name of the game's capacity, so it's there, but it's available at perhaps different terms and conditions, rates, etc. So thank you for that. I'm glad to hear that we have that base covered. I'm sure that our clients are happy to hear that as well, so plenty to do there. Hey, George, I'm going to move on to you now. Within the kind of the casualty brokerage area, if you will, that market remains, really challenging as well from a rate and a capacity standpoint. Some may suggest that there's been a tamping of recent, but I've also was at a seminar myself a few weeks ago suggesting that even if there was a slight tamping, it's going to get back up to where it was. So still a real difficult marketplace. Tell us about what the challenges are there from both a rate and a capacity standpoint.
Yeah, thanks, Paul. So as far as casualty goes, auto is the first one that comes to mind, just because it has been that way for a couple of years. I'm sure that people have attended some of these P&C Outlook quarterly webinars in the past. They've probably heard people harping on about auto a lot. They've probably heard the buzzwords like nuclear verdicts and large judgments being thrown around. I think as far as nuclear verdicts goes, this is just now the commonplace verdict. This is something that there's precedent set, where you're seeing these large auto claims completely blowing through multiple excess layers of limits, And that's going to probably stay that way until either there's some bureaucratic intervention or something happens legally, whether it's state by state or federal. I don't see that happening. I think there's a lot more issues that will take precedent over something like that. But these verdicts are gonna keep rolling in, and capacity on the auto side is going to continue to shrink and continue to be hard to obtain because of that. Other areas that we see some issues, habitation and hospitality. I lump those together because both of them have sort of become difficult for the same reason. That's assault and battery. You see a lot of A and B claims that have burned through entire books of habitational business. And on the hospitality side, depending on a region, you also see dram shop issues, over-serving issues. So there's definitely difficulties there, and carriers are kind of responding in one of three ways. They're either pulling out completely, they're tightening terms and conditions, or they're just increasing rate. Maybe they'll be offering the same terms and conditions, but they want a lot more pricing. Sometimes they'll do a combination of the second and third ones that I mentioned there. And then excess umbrella, especially on a lead basis, when you're looking at larger accounts that need layering, you'll probably find 8 carriers that will want to be attaching exit 5 and 10 for each carrier that will actually pick up a lead exposure. Especially going back to the auto, if it's a large contractor's fleet or a large trucking schedule, you're looking at a few players that want to actually entertain that buffer layer or the first, anything in the first 5 mil. So those are the areas that I think are currently the toughest and have the most limited capacity out there.
Thanks for that, George. Really appreciate it. You didn't use these words. I'll use them. Tort reform. That's been discussed I've been in the industry over 35 years now, and it's been discussed for over 3 decades. I'm sure it will continue to be discussed. Anela, I'm curious, do you see any similarities in the umbrella excess space on the personal line side, following what George just said on the commercial?
Yeah, definitely. I was just thinking about that as George was talking. Over the past few years, we've seen different umbrella carriers or excess liability carriers kind of either exit the market or completely transform the way that they write business. And those that have just kind of dabbled in it have completely pulled out altogether. But because of, personal auto not being extremely profitable in the past few years, and because of the large claims, the umbrella market has really tightened up. So you're seeing limits increase to, at one point you could do 100, 300, and then it moved to 250, 500. And now a lot of carriers are looking at wanting 500, 500, or 500 combined single liability or single limit. And then the amount of coverage you can get has shrunk also. So altogether, that space has shrunk considerably for a lot of the same reasons that George was talking about in the commercial space.
The similarity to nuclear verdicts, runaway juries, all of those things, right? Doesn't make a difference whether it's an individual or an organization. Thank you for that, Anela. Yuri, kind of a similar question to you, but really more from a contract bind perspective. What are the difficult things? I would imagine that there's similarities with some of the comments made earlier there, but from a contract bind standpoint, tell us a little bit about the challenges in your world.
I appreciate the question, Paul. Thank you very much. I would say there's multiple challenges in our contract bind or delegated authority space, new entrants into the market space. We see that as a challenge, because they'll come in pretty aggressive and they'll cut the rates a bit, and then all of a sudden next year we're looking at a possible rate increase. So those are big factors. Also, the admitted side, the admitted markets are coming into what traditionally were E&S type accounts and type risks. So specifically construction, we're seeing them getting involved into some of those smaller artisans that we normally would place in our space. And now they're trying to get into that as well. So that's been a pretty big challenge for us. And as George mentioned, different classes of business, hospitality, habitational, those are definitely still pain points in our space, along with liquor liability as well. So we're trying to find avenues and see what we can help our insureds and obviously our agents to fix or find solutions to their problems. And lastly, I'd say is some restricted property authority. We normally had higher binding property authority up to say 5 million in total insured values. And now most of our carriers are scaling back and cutting that in half to 2.5 million in total insured value. So we really have found a struggle when it comes to more property placements where it's in between, say, a brokerage side and a delegated authority space. So those have been really, really challenging and a little bit difficult for us to help our insureds.
Yeah, hey, we're fresh off of a few weeks ago, the WSIA event, and we're hearing many same things from our carrier partners there as well. So Yuri, I'm curious, as a follow-up to that, do you find it that more frequently now you need to start packaging up some property and casualty and other lines of business together in order to kind of entice the market to give you terms and conditions on all of the lines needed?
Yeah, definitely. I think that is one thing that our carriers prefer. Majority of our delegated authority contracts that we have in place are really our casualty-driven carriers. We have a couple that are really property-driven, but again, they limited their authority. So most of the carriers that we're working with, they prefer to package the casualty, or the casualty to be the driving force on the account, and more of a property as not an ancillary coverage, but a secondary coverage for not really being the driving factor of the specific risk. So yeah, so they prefer to package, if it's liquor, general liability, and property all together, more so than they would want to write a standalone property piece of business at this time.
Yeah. So, you've mentioned liquor now a couple times, so great segue into a liquor conversation. From that standpoint, there was a very robust standalone liquor market for quite some time, right? That is really becoming, it's diminished, to say the least. So what are you doing with respect to our clients, trying to help them when they have the need for the liquor liability? What's the process there, and what are you seeing in that marketplace?
Sure. We've seen, multiple issues arising out of this for years ago. So we feel we were pretty well positioned in trying to figure out what our different avenues would be when it comes to liquor liability, specifically the more standalone accounts that we see. So we went out and looked through the markets and wanted to find a couple good carriers that can possibly do the standalone liquor or even the packages. So we recently brought on a few different contracts, one local contract in Chicago area, a few others that are national presence as well. So we've tried to figure out an avenue of what makes sense for us, but also for our retail agents and eventually the insureds to feel comfortable with the product we're trying to sell them, and also an avenue that will provide some type of coverage, albeit it might be eventually restricted, a little bit more restrictive coverages, but at least we're trying to find some type of solutions for our clients.
Right. Okay, well, hey, challenging marketplace, but that's why we're in the E&S world, right? Because that's what we do for a living. So I'm sure we have solutions on all of those things there. Changing gears a bit and back to you, Anela. It would strike me that based on some of these, the opening comments here over the last 10 minutes or so, there's a real need for, from a turnaround time perspective, right? What's changed? What's the expectations in turnaround time on quotes these days?
We're a couple years ago, it may have been 24 hours. In a lot of cases, we're looking at, 48 hours to a little bit longer, depending on the situation. And it's mainly due to, underwriters and carriers really wanting to look at every risk from every possible angle, going forward. So where we had something that could have taken two hours, it may take 2 days now. And that brings in communication. So if you've got a rush, if you've got something that's, really on high alert, we need it done now, that's when you need to pick up the phone from really all parties involved, retail to us to the carrier. Communication is so important as we continue to navigate this hard market. And, to further that, incomplete submissions make an even lengthier turnaround time even worse. So making sure those applications are complete, making sure that if there's any, delicate pieces or really wonky pieces to the puzzle, that we're getting those up front so that it turns things around as quickly as possible.
Yeah, and we'll talk a little bit about that later on, about turnaround times and quality submissions and all of that. We tend to talk about that each quarter, but it's not going away. So
Still going,
we'll jump into that. We'll jump into that a bit later on. George, back to you. We talked a little bit about casualty. Yuri talked about packaging up property and casualty together in his bind space. From a brokerage standpoint, strictly a brokerage standpoint, talk to us a little bit about what's going on in the property area of brokerage accounts.
Sure. So, whereas the pockets of hard market and casualty are focused on class, obviously hard market and property is more on region, right? So, the West Coast out here, we're seeing not only California, but other parts of the Southwest affected by the wildfire issues, causing lots of tightening of capacity. And you only really have a few select players who are even willing to entertain on a lead basis the high brush fire wildfire risks. So there's been an inundation of submissions into these carriers. So it's definitely, and a lot of them are raising minimum premiums just to cut out some of the smaller business that's coming through, so they can prioritize. So you're seeing, maybe 3 carriers to do a lead 5. You'll see a 1.25 part of 2.5 quota share between 2 carriers, and then a 2.5x of 2.5, just to get the first 5 million done on maybe on either, it could be a smaller mid-size or a larger property deal where there's wildfire exposure. So that's been the challenge out west. When you talk about coastal going maybe back east, that's been the issue as far as, and then convective wind areas as well. So you're seeing similar layering challenges there when you get to the named storm and the cat exposed up on the East Coast. That's just been going on for a little bit. 5, 6 years, 5, 6, 7 years of pretty bad cat losses, and so you've got markets becoming a lot more conservative of how they're deploying their capacity in those areas. So yeah, the layering aspect is important, and it's also, something I may add is if multiple wholesalers are involved in the equation, it becomes even more challenging, because you got underwriters understanding that there isn't a bunch of control in the account, and then you might have, when you're layering, you run into issues with markets being blocked. So I guess the takeaway from that is trust your expert. Trust your expert at Burns. We have all the markets, and so it's important to put it in the hands of one wholesaler so they can layer it appropriately, and that'll definitely help their case.
Thanks for that, George. It's a bit scary, to be candid with you and our participants today. When we have to layer 3 layers and to put 5 million in TIV together, that's a difficult marketplace. Let there be no mistake about that. And then I'm sure everyone, probably listened to the same news that I did this morning on my drive in with what's going on down in Fort Lauderdale today, with the massive rain there. Not even a named storm. We're not even in storm season yet. And the Fort Lauderdale airport's closed for more than 24 hours. That's significant. And I think we're going to see significant claims, both personal and commercial, coming out of South Florida as a result of this weather pattern that's over there now. So our thoughts and prayers are with all the folks that are impacted by that, of course. Hey, Yuri, back to you, and you chatted a little bit about this. You touched on new market entrants. It seems like all the time, right? When you're reading, it's there's another MGA popping up or another MGU popping up. There's new capacity all the time. Talk to me about what the vetting process is and how you go about that, and you have to feed all of these markets, right? So how do you kind of go through your due diligence to determine if it's a market you want to work with or not?
Yeah, thanks, Paul. So we have a process that we've kind of come into a thought of obviously who they are. That's the first question. Their financial backing. Are they A-rated? Do they have good backing? Are they going to be in the game long enough? I think that's the main question. As I mentioned earlier, we don't want to come in and get a contract with a new carrier, and then all of a sudden a year or 2 from now they've either double their rates or they just pulled out of the market completely. So we definitely want to see their stability. If there's going to be stability, if their financial backing is really, really good. The second part is technology. In our space, similar to Anela, a lot of it is speed. So technology piece, do they have a really good platform that our underwriters can use and can flip something around pretty quick, say 3 o'clock, 4 o'clock in the afternoon on a Friday when our agent needs something? And a lot of times we tend to gravitate to the companies that have the technology that we can get a quote out in 15, 20 minutes. So the technology piece, and I'd say the last piece is the personnel, the people at the organizations that we're looking at. Have they been in the market space? You know, if they move from one location to another, have we built a relationship? I think even though technology is big in our delegated authority space, there's still people behind the desk. There's still people behind the guidelines that they send us out. So definitely building a relationship, calling on our underwriters for a last minute favor, a last minute approval on something that our agents need. So all those factors, we really want to vet out and figure out what makes sense for our group to work with and build that relationship and be able to write good and profitable business on behalf of our carriers.
Yeah, hey, you know, you hit a lot of points there. Good and profitable business. If it's not profitable, they won't be around to pay claims. So it has to be profitable, right? We're making a promise to our clients to pay claims, so they have to be profitable. On the technology front, once again, back to WSIA last month, every meeting we had, technology with our carrier partners, that is, every single meeting we talked about technology. And we had the pleasure of having our chief information officer with us in those meetings. It is not only an important topic today, but it's becoming more important as time progresses. So we're just crushing it in that space with our platform, and you know, can't say enough about that. That's really the key particularly on the binding side there. Hey, George, over to you now. New market entrants in the brokerage space. Do you think that there's, you know, is there certain kind of classes of business that they're targeting? We talked a little bit before about HAB being difficult and some of the A and B stuff. Are some of these new markets that are they're existing carriers, but they're just starting to get into the E&S space? There's a few to come to mind. I won't mention them, but do you think that, you know, what are you doing in the brokerage side to, you know, kind of vet them and make sure that you know, that they're a good partner for us to work with?
Well, a lot of the times it's obviously determining the type of business they're going to be writing for us, or that we want to partner with, and that's often going to be a function of their background. If they come from a carrier that was mainly one of the mainstays in construction, then they're probably going to be focusing on commercial residential construction. If they come from a carrier that was maybe hospitality or OL&T, you know, writing most of that business, that's usually what we're going to be focused on. So obviously a lot of it's going to be whether there's an opportunity, whether we can partner with them and give them the volume that they might need. And we obviously have to focus on hit ratio as well. So we don't want to be inundating them with submissions that they can't write. So getting a full understanding of their underwriting appetite, what they'll be going into. I'll tell you that not many of the emerging markets are getting into these super tough areas. They're not writing GL on tough subsidized habitational with full assault and battery. They're not, you know, coming in to write you know, leads on wildfire for property. So they're obviously get, you know, the capacity that, especially the initial capacity to deploying in the marketplace is going to be on the more conservative side. They're not, you know, if they want to have a viable functioning, you know, a long-term plan, it's got to probably start with good loss ratios for the first few years. So.
Yeah, hey, you know, it makes sense, right? We talked a little earlier about the fact that you need to layer a $5 million property program now. So if everyone's cutting back their limits to a certain degree, you need these new entrants in order to fulfill the limit requirements. So it just makes for a whole lot more work on our side to put these deals together, the towers and the layering and all. Thanks for that, George. Appreciate it. Anela, any additional comments from new market entrants on a personal lines perspective?
Sure. You know, similar to what George was saying, no one's really chomping at the bit to write extreme coastal business right now. And if they are, I'd like them to give me a call after we're done here. But you know, we are seeing new markets enter, and they are, like George was saying, they're a little bit more conservative in how they're writing, what they're writing, and also similar to what Yuri was saying, we are seeing an emergence of technology. The E&S space has, you know, not used a lot of APIs historically, and we're seeing more and more of that. A lot of carriers using more third-party data up front on the quoting end versus just on the back end with inspections. But one market that, or one line of business that I do think is seeing a lot of emerging capacity and strength is the flood market, and we're seeing that everywhere. And we have an amazing flood team here at Burns and Wilcox, and I think that's a space that's just going to continue to grow, and we're just going to see it, just grow leaps and bounds over the next year.
Yeah, no question. Shout out to the flood team, no question. We have the best in the business there, and shout out to Brad and his team. So thanks for all of that. Anela, sticking with you, and kind of a great segue, right? Changing weather patterns, right? We could probably spend the balance of the afternoon chatting about that, particularly with what's going on down in South Florida right now as we speak. But changing weather patterns, how's that kind of impacting the personal line space, both, kind of historically today and what you see into the future?
Sure. Whether you believe in global warming, climate change or not, no one can deny that we're seeing more hurricanes, that we're seeing more tornadoes, that we're seeing more wildfires. It's just, that is what it is. And from that, we're seeing changes in the way that we insure property. Coastal areas are seeing higher deductibles. What was, you have 1%, 2%, even in some places, a flat deductible is unheard of. Now we're seeing 3%, 5%, even 10% in areas like Tri-County, Florida. And it's selling because that wind capacity is scarce, like we discussed earlier in the call. We're also seeing, inland business change as well. I know George spoke to convective storms earlier, but we're seeing more and more tornadoes. And those deductibles in inland, the Midwest, are changing from being flat to 1% to 2%. We're seeing more and more of that just as we continue to evolve with the way weather is changing. I mean, like you mentioned, the flooding in Florida, and then we just had those horrific hurricanes in both, I believe, Indiana and Mississippi just the last couple of weeks. So weather definitely plays into the way that our carrier partners are going to continue to change.
Yeah. Sure. So the tornadoes the last couple of weeks in Indiana. You said hurricane, so not quite hurricane season yet, but that's okay. So speaking of hurricanes, though, I did hear again, long drive into the office. I did hear on the radio this morning that University of Colorado, if I recall correctly, is estimating a tamed down hurricane wind season for us. So let's keep our fingers crossed, folks, and hopefully the University of Colorado is correct in that regard. Hey, George, Yuri, anything to add with respect to changing weather patterns from both the, from your vantage point? George, you first.
Yeah, I mean, I do have to say I kind of do feel for chief actuaries and chief underwriting officers, but, because they kind of have to wear multiple hats and be, those actuaries and chief underwriting officers, as well as climate scientists or meteorologists, and predict what kind of season is upcoming. I think they probably err on more the conservative side when it comes to deploying capacity in either convective wind areas or coastal areas. So it's definitely challenging. And you mentioned that University of Colorado study. I saw a study published a couple of weeks ago that said anywhere between 11 to 15 named storms, 3 or 4 of them could be relatively severe. So yeah, meteorology has advanced obviously since the 80s and 90s, but it hasn't got to the point where we can really safely say this is what's going to happen. These are going to be the named storms. This is when they're going to happen. So it's tough to be an underwriter or to decide how conservative you want to be. But obviously, we just have to be in contact with our carrier partners and understand what their appetite is for those types of risks.
Well, obviously we do that on an ongoing and regular basis. So thank you for that. Yuri, any additional comments on weather patterns and things?
Sure, and I can echo Anela and George as well. The stuff that we're seeing in the Midwest is obviously the tornado in Indiana recently. I mean, that affects us every day in the business that we see in the Midwest, and that has an effect on obviously rating or deductibles. We've seen, as everyone has mentioned earlier, wind hail deductibles. Normally it'll be a flat, $2,500 or $1,000 or $5,000 deductible. Now they're adding percentage deductibles, 1, 2, 3, even up to 5% in the Midwest. And traditionally, areas that normally don't see a wind deductible, areas of Chicago, all of a sudden are getting wind deductibles. So the changing patterns have really shifted, as George said, for the chief underwriting officers and actuaries. And we can't predict, obviously, weather, but they're increasing their deductible options, limiting capacity as well, as I mentioned earlier. And then obviously we do have also some national contracts where we do see some Florida business, and they're restricting some Florida wind coverage for us in the Midwest, and therefore looking at business in Florida or say Louisiana or the Carolinas. It's become more and more difficult to try to place this business, but we're doing what we can and trying to provide solutions for everyone.
Yeah, no question. And, that's, once again, we're in the E&S specialty marketplace. That's what we do for a living. This is our bread and butter. So I guess what's interesting, though, Yuri, in your comment there, I just want to point out that we really need to educate, make sure that everyone understands that policy terms and conditions are changing. So when you go from a dollar deductible to a percentage deductible, we need to make sure that our retail partners know about that, and then the named insured ultimately knows that too, and they're not surprised when that claim comes along. So really important that we review policy terms and conditions, perhaps more so than ever with all of these different changes there. Hey, Yuri, I'm going to stick with you for a moment. And again, we talked about liquor. George talked a little bit about HAB and some other areas. What are the other kind of sticky classes of business that you're finding it difficult, whether it be from a property or a casualty or a professional standpoint within the contract bind space? Are there other areas that our clients should be concerned with, or that you can point out to them?
Yeah, definitely. And we can talk about HAB and hospitality all day. And I think those are some of the main classes that have been difficult, either carriers pulling out or restricting terms. As George mentioned earlier, A and B for hospitality type business, the locations, where they're located. Have there been any losses? What's going on in the surrounding area? I think that our carriers, as Anela also mentioned, third party, they're getting information and therefore trickling it down to us, and therefore trying to restrict the specific coverages for hospitality business, and similar to habitational as well. Another one that's been fairly difficult recently, and we've noticed this from multiple carriers, is daycares. Daycares with children, they tend to get injured. They tend to do silly things. And therefore we've seen some daycare issues with our carriers, either pulling out, increasing their minimum premiums, adding an abuse and molestation exclusion, or just sublimating it. Normally, some carriers that were silent on those additional coverages, and now they're just restricting what they're specifically wanting to offer. So we're doing what we can, and we're navigating, we're providing a solution. It might be a little bit more restricted, but we at least are providing some type of solution for the risks that we are seeing every day.
Yeah, hey, back to what we just talked about, right? Terms and conditions, it may not be the same as it has been. So we really need to make sure that we're pointing that out, and everyone's looking at their quotes and their policies very closely. George, I would surmise that a lot of the things Yuri just talked about are similar in your world on the brokerage side. Is that a correct assumption on my behalf?
Yeah. I think as I alluded to earlier, the in the hospitality habitational space, the carriers are deciding to limit terms and or pull out completely from offering certain coverages. Assault and battery, firearms, habitability has become a very common exclusion for habitational. So it's definitely a tough space, but I think to combat that, we ultimately need to have multiple options on the table. Maybe a lower priced option with maybe the sublimits or exclusions, but also a more beefed out coverage option that's going to be maybe some sticker shock for the insured. But ultimately, we wouldn't be doing our jobs as brokers if we didn't provide options that have the best possible coverage as well. And there's also contract requirements. You might have banks and lenders that say that are more savvy, and if they see certain exclusions, they say, well, we can't have you accept that policy. We need you to have a policy with at least this amount of assault and battery or silent on assault and battery. So yeah, we just have to be wary. And you know, my advice to any retail brokers or wholesale brokers is just carefully review your renewal quotes, and you know, as these terms are tightening, and you know, certain times you won't get a heads up.
Yep, absolutely. Terrific. Okay, so we're winding down now. We have another 10 minutes or so left. I thought I'd kind of change direction in the conversation here a little bit. And this is a question addressed to both Anela and Yuri, where you have contract bind, right? Where we have the authority on behalf of our carrier partners. We talked a little earlier about profitability and why that's important. Carriers need to make money in order to be around to pay claims ultimately. So, you know, you guys each have some contract bind teams, right? Yuri, you have teams throughout the upper Midwest. Anela, you're responsible for the personal lines teams here in the East Coast. So what are you doing with your teams to kind of help them to ensure that we're writing profitable business and that we're doing all of the things that we need to do, not only for our clients, but also for our carrier partners? So Anela, if you can take that question first, please.
Paul, I tell my teams, you know, think of three things. Who are you insuring? You know, are they a high profile individual? Is it an LLC? Is it a trust? Is it an estate? What are you insuring? What is the actual exposure? What is your retail agent looking to get? And who are you insuring it for? You know, who is the person sending you the submission? Is this a really good relationship you have? Is this somebody that you just met at a conference the other day? Because those three things really play into what carrier you're going to go with, what contract you're going to write it with, and having that story, if you need it along the way to kind of present your case to a carrier, is going to help you 100%. So those three things are extremely important right now.
It sounds basic, right? But it's so important, right? Who, what, and you know, it needs to be a client that, you know, that we have a well-rounded relationship with, right?
Right.
You know, we have lots of personal lines capacity and perhaps others don't. So, you know, we need to get some commercial lines business to support the personal lines products that we're sending out there. Yuri, from your standpoint on the commercial lines side, what are you doing?
Yeah, similar to Anela, who are we insuring? That's the first thing, and what we're getting in. Obviously, my team, we tend to try to see if there's a website. A lot of times these businesses have websites. If we're looking at products liability, what are they selling? Their application may say one thing, but you look at their website, they might actually be selling other things outside of what's on the application. So vetting that process and looking at vetting the process and seeing if we can find additional information on the insureds. Second thing is obviously carrier guidelines. Carriers update their guidelines, if not weekly, daily, monthly. So constantly making sure we're writing the business that our carriers want to write. If one carrier doesn't want to write it, we have other avenues, other options to see what we want to write with that said carrier. So carrier guidelines, getting the full story, understanding what we're doing. And again, lastly, as I mentioned previously, is having a conversation. If you're unsure of something, have a phone call with your underwriter or with me, and we can discuss the accounts and to make sure, like I said, that we're writing those profitable businesses, profitable for the carrier, so they can be around, as Paul keeps saying, down the road in the event of a claim, they can pay it. So those are the processes that we really try to implement, not just in the Midwest, I think across all of Burns & Wilcox, is making sure we're doing the right by our retail agents and ultimately the insureds that are paying for their coverages. And we want to provide the right coverage for the right risk.
Yeah, no question. Thank you for that, Yuri. I think, you know, George, from your perspective, right, you're not underwriting the risk, you're submitting it to your carrier partners, but I would think that, you know, it's a similar obligation, right? We need to have, you know, protect that relationship, if you will, and make sure that you're providing them with the business that they have within their appetite, and that you're mindful, and we touched on it a little earlier, of, I use the word bandwidth all the time, of their bandwidth, right? So, you know, if we're submitting something to them, you know, it has to be pretty high probability that they're going to quote it and hopefully bind it, because they don't want to just be, you know, kind of putting quotes out there to keep others honest. Is that a fair comment, George?
100%. And pre-qualifying is a massive part of what we do, and understanding what the opportunity is. And so the more, the more often we get submissions where that's included in the submission content and what the opportunity is, someone non-renewing the account, or has there been a crazy rate increase, or has there been a terms restriction? So pre-qualifying and understanding if it's an opportunity is a big part of being a broker, and a successful one is not spinning your wheels or spinning the underwriter's wheels on business that might not be viable for that.
Yeah, hey, thanks for that. So we're down to 5 minutes. I always like to kind of end with really kind of a two-part question, and that is to allow you guys to kind of free form, say what you'd like to our audience today, which includes, by the way, carrier partners, retail partners, insureds. I'm sure we probably have some competition on this call as well, and some press and so forth, which we typically do, and we're thankful for that. So. But maybe to start things off, Anela, let me kind of give all three of you like a little bit of a lead on the question, right? So anything you'd like to say, but start off with, what can our clients do to position themselves properly in this challenging marketplace? How can they help us to help them? Anela, you want to take that?
Yeah, the first thing that comes to mind is please don't flood the market with your submission. In a lot of cases, we're working with a lot of the same carriers, and you're only hurting yourself by sending it to 7 people at the same time. So loyalty goes a long way. Relationships, insurance is a relationship business. So, stick with your wholesaler, and if you submit it to them, wait for them to respond before you just shotgun it out to everyone. That's going to help us all in the long run.
Yeah, I call that muddying the waters, right? Everyone loses in that instance. It's just a colossal waste of time, no question about it. So, Yuri?
Yeah, I think exactly what Anela said. Definitely, we like to build a relationship, and first of all, and both with our carrier partners and our agents. So we want to be sure that we're the wholesaler of choice and the company that they want to work with. So flooding the market doesn't help anybody, as Paul said. But as I mentioned, of a story. Is there a story on the account? If they have any background information, loss runs, target pricing, expiring pricing always goes a long way for us. So we know where we need to be and try to win that business. And those things obviously help us to also decide, does it fit in the delegated authority space, or do we have to go more to a middle market, like a light brokerage type space that we can find solutions for them. So just all the information that you can provide will definitely help make our job easier and hopefully get you a quote quicker and for the right coverages that you need for your insurance.
Sounds like quality information to a target of folks like ourselves, right, to get out into the marketplace on their behalf and tell the story, whatever that story may be. Could be divested operation, could be a newly acquired operation, who knows, right? Some risk control measures that have been put in place. There's so many stories that can be told, but that's ultimately what we're doing, is we're telling a story when we're brokering a piece of business on behalf of our clients. George, anything from your standpoint?
I mean, Yuri and Anela pretty much nailed it. I will say that submission timeliness is obviously a big thing, especially if it's a renewal that needs to be marketed, or obviously a new piece of business. If we're getting an Accord 125 and 126, and that's it, with an effective date 2 days from now, there's a chance that there's not going to be it's not favorable chance that you're going to get a good turnaround and get viable terms. So submission content, submission timeliness. I actually put together a couple templates for submission content from multiple different classes of business and what should be included in the attachments and the emails. So if anyone wants to reach out to me and sort of get your hands on that, or I'd be happy to share it, except if you're competition, of course. I'm probably not going to answer the phone and give you that. But yeah, I think it's incredibly important for underwriter prioritization to have all the information, especially in the tougher classes where the underwriters are going to be inundated with submissions. If you put together a good submission, you have all the information at their fingertips right there, then you're going to have a great chance of getting prioritization from the underwriter.
No question about it, right? Quality counts, quality over quantity, and I think that really wins the day. It sounds like you have a best practice there, George. You should share that internally with your colleagues, so we can all probably take a page out of that book and not reinvent the wheel, so to speak. So, well, it's showing 2:15 here in the East. I just wanted to say a sincere thank you to Anela. A sincere thank you to Yuri, and a sincere thank you to George. We appreciate your expertise. We appreciate your time. Our clients are lucky to have folks like you out there fighting the battle for them, and it's always terrific. We kind of learn from each other when we go through these quarterly conversations, and we're still in a real challenging marketplace, but nevertheless, it's our time to assist our clients in getting all this stuff done. So thank you to our audience today. Thank you to the participants today, and we look forward to seeing you next quarter, when we do this in early July. And then finally, be on the lookout. We'll have a written piece that will follow this up probably within the next 10 days or so. So be on the lookout for that. Thank you so much, and enjoy the balance of your day. Bye now.
See you, everybody.
Take care.